Good afternoon, everybody. I'm Dan Hussey with Zaner Ag Hedge, bringing you a strategy of the week update here for August 18th, 2022. Remember, trading futures involves risk and is not suitable for all investors. And everything I talk about here today is just my own opinion and not a direct trade recommendation. But as always, if you want to turn them into trade directs or talk to me more about how we can service your trading account and help you with our expertise and abilities over here at Zaner, including my own, feel free to give me a call, 312-277-0110. Find me on Twitter, Facebook, or shoot me an email at dhussey@zaner.com. All right, kind of a big day for depending on what markets I guess you looked at. Quiet day for others like the stock markets and bonds, but our ag products actually started to get a little bit of life into them. Whether that means meats kind of rolling over or row crops getting a little exciting, with the exception of wheat. There was definitely market movement, and I think a lot of that can be attributed to the fact that we've been in pretty tight ranges, consolidation, going sideways for a period of time. Wheat is a great example of that, and we're going to begin with the wheat chart today, starting with a look at September wheat here. My chart will load up for us. We'll look at the KC and the Chicago, both going, into oversold territory in the daily RSI. I don't know why my Chicago wheat, there it is, didn't want to load there. We've been trading lower, in a trend since that June top for the inflation trade, since we started walking back on the Ukrainian-Russian crisis, since we've had talks and rumors of potential wheat and other row crops making it out of the Ukraine via, the sea or rail through Germany and what have you. That still remains, the case, and it seems to be that we are now starting to swing the pendulum in a very extreme way to the other side of the case. We're now below the levels, well below the levels that we were holding or trading above, I should say, into that crisis. We're now pushing, down to the lowest levels of the year here today. In our wheat contracts. So we're making 2022 lows as we speak and starting to retrace, the gains that we had seen in 2021 there and into the end of the year. So it's kind of fresh territory, and the downtrend can't really be ignored at this point. We certainly were hoping that we had the case for a rounding bottom here, but the subsequent failure of the last 3 days has certainly taken that idea and the wind out of the sails for the market. A strong U.S. dollar is certainly weighing on wheat exports at this time, and probably a good reason why we're down 31 cents there in the Chicago contract, 38 and a half there for the KC hard red winter, and down 30 there for Minneapolis spring wheat. So not a good look for wheat. I don't have much in the way of a rationale or reason other than when we take a step back and we look at what we've done for the last month and a half sideways in this range, this market needed to, break out of this range higher or capitulate lower, which, the sell-off might very well be that capitulation. Again, we're now oversold in that daily RSI. I'll keep an eye on that. The 18-day moving average comes in around 787, is going to start to get dragged down now here. We only spent a few moments and even a day and a half there above that figure. 200-day moving average up around 911, 55-day sloping down towards 85, with the 100-day, the highest moving average right now at 982. So we did have a bearish cross over the 55-day over the 200-day moving average, and a week later, we're at new lows for the year. So we'll see what continues there. Chicago wheat didn't lead the way today. KC wheat actually led the way. A little bit of unwinding in the protein premium spread, and not quite oversold there in that September wheat contract, but I think we'll probably get down there. Made a new minor low for the day, but did trade down 38 cents. So I think that resulted, generally speaking, into a little bit of a retracement here, and that KC Chicago wheat spread. I'm pulling that up now because I do want us to take a look at that. because it might be buying opportunity there for those that didn't get into this trade. On the last trade, or move down towards the low end of the channel here, the last move down to 55 cents over, traded all the way up to 74 and 3/4 cents over. I'm anticipating now this pullback in the protein premium spread here to have a kind of catch a bid here around that 60 figure, and then now the upside target is another 20 cents higher towards 80. It is important, and something I want to point out here is that if you look from about mid-June, when the market, sold off from like 117 in the KC contract down to $8.30, or I guess $11.50 down to $8.30. During that period, we saw a little bit of bear spreading in this chart. But then it was interesting to note that come the start of July, when the market, arguably continued lower by about $1 in the spreads, or I'm sorry, in the outright futures, we started bull spreading. And with the exception of today, generally speaking, this bull spreading has been intact with these, regardless of what the outright futures are doing. So the big sell-off today, I think, is a good reason that this, spread kind of narrowed a little bit, but I anticipate that trend channel to continue to hold and potentially take us up to 80 cents over. And above there, we could test back to $1 over. You can see this spread has just been in a big range here, depending on how you dictate that range, but as high as $1 to $1.40, and has found support consistently down here around 40 cents over, and we're trading off that low. So continuing to anticipate some bull spreading there, and today might have been a day to add and bull spread, buying the KC, shorting the Chicago. And like I mentioned before, one of my favorite trades from last week that I talked about was if we're getting long KC wheat in some capacity, we'd end up selling Chicago against it rather than getting out of the KC wheat. And that's just a kind of an interesting dynamic to think about going forward here. All right, so let's flip our gears here and talk about kind of the big winner for the day in the row crops. Soybeans, September soybeans up 20 cents there into the end of the day. November beans up 15.25. We traded back above the 200-day moving average, kind of the level that we've been flirting with, that comes in right around $14 at this time, $13.98 to be exact. The 18-day moving average up around $14.13 was resistance here into today. And there was another resistance on the September chart that makes me a little worried about what beans might be doing here. But all things said and done, this was a bullish engulfing candle against yesterday's inside candle. The highs from 2 days ago at 14.1375 were not taken out today with a 14.13 high, and the lows from 2 days ago at 13.76 even were not taken out with today's low at 13.76.5. So we're still inside 2 days ago's price action, but this is a bullish engulfing candle outside yesterday's price action. So follow through the highs here at 14.13. Expect the market to probably get back up towards the 14.32 to 14.40 and potentially even test that 100-day moving average up around 14.60 yet again. And again, in larger sideways consolidation. Of course, below this double low that we've got here at the 14.76 low, that's going to get hairy in a quickly with an open gap still down around 1348, 1350. I feel like we could get down there. RSI on the daily chart right in the middle of the range, and arguably just in a big old range right in the middle of it in terms of price as well. Remember that September contract I mentioned? It actually did penetrate 2 days ago's high. It actually made its way up to the 100-day moving average. So at this time, if you're going to be a buyer, I think it makes sense to be a buyer in the September and a seller in the November here, as we're continuing to see that a little bit of old crop, new crop spreading to the tune of 5 cents here in favor of new crop higher, building that premium in, taking out carry, and keeping markets inverted, which is I think a showcase for the worry that not necessarily that November's production won't be there, but because anyone that needs beans in the pipeline now, it's tough to get them, and we're seeing commercial interests probably willing to pay up for that. privilege. 18-day moving average here on the 18-day moving average here on the soybean chart is now support. We've been holding above the 55-day moving average. So unlike the November beans, which are fighting to break, back above the 200-day and holding the 18-day moving average as resistance, the September contract is holding the 55-day average as support and that 18-day moving average as support as well. So again, leads me to believe that your better bid on the September here rather than the November. But we'll see how that trade continues to play out. November beans on the 4-hour chart, as we've been talking about the last several weeks now in these Strategy of the Week updates, they're getting a little monotonous and we're sounding like a broken record. But having broken the full 61.8 line of the decline off of the highs up at 1472 on this push up in the end of July, and then falling back to break the 61.8 line of the pull from the lows to the highs there, that calls into question this big old wedge or range-bound price action for the foreseeable future. And that's really the justification, I think, for the rally we had today. Just short covering inside of this range. Maybe the market's going to go back up to 1430, 1440, 1450 to test the high end of the range yet again and just be in sideways price action. I am somewhat concerned about the September contract. We'll come back to November here in a second. But that September contract, we saw a full 50% off the highs actually get a reaction today at $15. So I'd like to see September break above $15 and get up to 15.10, really 15.17 to 15.20. And then I feel a lot more confident in the uptrend that we're seeing progress, because from a pullback standpoint, the full 50% from lows to highs didn't really trade down around 14.31. A swing from the 1390 low to the 1557 high broke their 61.8 line. So technically speaking, I'm not shocked to have seen the full 50% short off the highs here at $15 get a reaction so far, right? We sold off from 15, we went down to 1485. That's a 15-cent sell-off. That's enough to get somebody who had a stop up here at 1515. If you sold 2 units there, you could have taken one off on that 15-cent dip and had a stop up here at 15.15 relatively risk-free, because you're risking, the 2 cents or the 15 cents you made. Let's call it 13 cents you made for a 13-cent stop. That's a strategy or a methodology I call getting free or reducing risk that we use in futures trading often to try to minimize our risk exposure on initial reactions on trades that we are wanting to be a part of. Rather than trailing a stop down from like 15.15 if you were a seller at $15 down to $15, which is now at risk of getting, ticked out here like on the open tonight or something if we just pop a little higher. Keeping the stop up there, but booking half of your profits on if you have multiple units on at a first target that's equal distance to your stop is a good way to minimize risk. And that's a strategy I used to implement for my own account and for the funds that I used to trade actively for before becoming a broker. Okay, next on to bean oil here, and then we'll get into corn, don't worry, and crude oil as well, and everything here. Bean oil, real quick, we're back down to testing the 200-day moving average and that 18-day moving average. So we flipped kind of the script of being in a bit of a bear trend and then now bean oil taking, steps forward, back, steps forward, back, steps forward, back into supportive areas around here, around 63.50 to 64.27. Very important and awesome to see those supportive areas holding here on the chart. A move back above that 55-day moving average at 65.50, and that would be a back above today's highs, would certainly constitute a reversal off of today's low, and would probably take us in a swing back up to 70, and for a test of that 100-day moving average yet again. We've unwound the overbought condition here on the bean oil, so if it wants to hold support at this level and trade up to and through those highs, love to see it happen. Meal, The meal chart also with some strength today, but very, very sideways, kind of like our outright soybeans. So if we're bullish the oil, meal is kind of going sideways, but has at least got a 2-day uptrend that has also taken out that inside day from yesterday and 2 days ago's high. That's a trend that here we've seen on the September contract in outright beans, the meal contract here, and we're just waiting for November beans to maybe catch up in that regard. Yeah, bullish above, bearish below this 395 area for the meal. And then on the soy oil chart here, I'd say now risk around today's lows at 63.43. That's probably my line in the sand now for keeping this uptrend intact. All right, so today for December corn, we finished positive at 3 3/4 cents. An outside day to the upside. We're going to need tomorrow's candle to confirm a reversal higher. But okay, 2 steps forward, 1 step back, 2 steps forward, 1 step back. We've now filled the gap at 607. We have an open gap still below us. And the chart is, just hanging on, but staying above that 18-day moving average at 612 now. We never went down to oversold conditions, but we unwound overbought conditions. So the market wants to start heading higher. And from that perspective, it can. 200-day moving average seems to be the line in the sand and the nut to crack to the upside at 628. So above 630, I think December corn can get its run and act together for a move, up towards 660 to 678. And test that 100-day moving average. There's also, open gaps further above that we'll look at on the smaller time frame chart here in just a minute. But so far, the recovery in corn, we would have liked to have seen last week's rally, just continue right on up. But again, if we had rallied up there too far too fast, it might be, coming out of that WASDE report, it might have been just the exact same type of price action we saw this time last year, which, as a reminder, for both Nove beans and December corn, that WASDE report, that August WASDE report, ended up marking a swing high that then for about 3 weeks to a month afterwards, we had, some steep selling pressure. Corn bottomed out on September 9th. That was the low to have bought corn that you could have held as a swing, and obviously rolling futures contracts forward, but generally held that as a swing all the way through May and June of the following year. Beans did have some recovery rallies, but ultimately continued to get pushed down to make new seasonal lows there all the way into November before they bottomed. And, we might see that type of dynamic here with a corn harvest low time frame trying to form, swing low trying to form here over the next month or so, and then beans, taking a month or so after to formulate that similar level. And that's, again, I sounded like a broken record, but while we're in these ranges, that's all we really have to talk about. So the 4-hour chart for December corn here, we came down to fill that open gap at 607.75 this week. We're kind of below this upward sloping trend line that I would have liked to have seen it hold. Certainly trying to hold below, a false break there on our WASDE day of this downward sloping trend line. But arguably, we did break back above this trend line against the highs for the last few days that kind of held this trend channel lower. So, a push through 620 here today and move up to 630, I think confirms that corn, in my opinion, wants to get to 660, 680. Try to close that open gap up around 673 and maybe still retest 666, full 50% retracement, from the swing at 766 up here. Down to the lows, which actually it's a little lower here, I suppose. Okay, 663. What's a couple pennies here on this bigger chart? Now, that daily time frame, I'm continuing to point out that for December corn from 370 lows up to the 766 highs, full 50% retracement at 567 traded and is held. And so far, we're kind of turning the boat here a little higher. That doesn't mean that we can't test down to $6 or, try to go to fill this gap down around 584. Let's bring up like a 15-minute chart here in the near term. There we go. There's a lot of lines here. Kind of ignore them for a moment. But that open gap down around 584, that was from all the way back here on the end of July. The longer we keep that gap open, the less we, consider its ability to fill, but we're continuing to monitor that. Now, there's also the gap lower to start this week, which I'm not gonna lie, I kind of forgot about it until here recently. We closed last week on Friday up around 639. We opened at 636, only traded to a high here of 638 before falling back down. So there's kind of an open gap up here around 639 now too, which to me also has a bit of a target now on its back for a move a little bit higher here. Intraday, corn was stair-stepping lower. We held 50% shorts off the high to low on Monday. That 630 figure, you can see that 2 steps forward, 1 step up, 2 steps down into the 612 target next in the series from entry highs to, arguably target lows here. Might have gotten a little front run there at 618. We had this kind of expanding structure. And arguably today at 620, you got to ask yourselves if did we just trade up into the next in the series kind of short here in the near term? Now, this might also be a 61.8 line test. So, arguably right after we traded that level, the market pulled back, defended 61.8 lines from the low to high of the day, and got a reaction higher here in the near term. So, okay, there's a bit of a fight going on over trend, and corn's not willing to give it up yet. Even though I think a break, back down below 610 and certainly below 604 for the day, it's going to call into question filling some gaps below us. I'll move back above 620. Going to 630, and ultimately, I think going to try to fill that gap up around 649 in the near term. So we'll keep an eye on that here for us. Moving on, let's talk feeder cattle and live cattle here for a moment. We're going to bring up the daily charts real quick, take a look at where, let's start with feeders here. Feeders going out the day 187.67.5 in the October contract. That's down 1.875 on the day. Still holding, somewhat of a channel up. We got trend lines against the lows that you could make an argument come in around the 185 to 186 area. But after yesterday's pretty strong move to test the 190 figure and subsequent sell-off here today, we've got a bit of a double bottom here that if we reverse back below 187, we get down to the 18-day moving average and get below it here at 185.83. I think we could be on our ways in the feeders to test, to test a little bit lower here towards the 100-day moving average around 181.50, or excuse me, 179.57, and the 55-day at 181.57. The feeders again have an upward sloping trend line. Let's take a look at the smaller time frame chart now to take a look at that level as well. And the live cattle, both feeders and live, very similar charts in some degree here. But upward sloping trend lines, depending on how you kind of draw some of these here, I'd say there's support at 186 and then down around 183 from these levels. The next in the series, feeder cattle long, has traded to target. So from our 168 lows to highs, we had a 50% retracement here down to the 175 area. There, move that original level. That traded up into its targets. Okay, so you can see that swing 2 steps forward, 1 step back, 2 steps forward. And then it took 1 step back from entry lows to target highs. Next in the series here traded. Make an argument that it had a little bit of a front run, but held that 180 area. 2 steps forward, 1 step back. We've now traded up to the 190 targets. So a swing here from this 180.80 low up to the 192 highs. Also has support coming in around the 186 area. And then, of course, got to drop the full 50% of this entire swing, consider the 180 area. But, I wouldn't necessarily be a buyer down here at 180 unless we see, unless one, you're short taking profits, or two, we see some key reversal going on a daily time frame, because we will have broken all the trend lines coming and sloping up against the lows that have been a pretty clear indicator of this upward sloping channel and trend higher. We made a new contract high here for October cattle. Good reason to see a steep pullback here as well. And if we get, if they follow the hogs and live cattle confirms a move here, it does look like, who knows what the cattle on feed report will say this Friday, but it does look like a top could form in our feeder cattle and live cattle contracts at this time, at least to this trader. So we'll see what happens there. Live cattle going out today at 144.75. Also, in a bearish reversal candle here, a key reversal after kind of a doji there. Similarly to our live cattle or feeder cattle, you can see trend lines against the lows, how they kind of come in probably around this 144 area. The 18-day moving average at 143.69, the 200-day down around 141, clustered around that 55-day and 100-day moving average as well. We're coming off of overbought territory in the live cattle contract, and we traded right on up in live cattle to fill that open gap back from April. So now the gap's filled. We have nothing to the upside that we feel like we need to go and clean up on this chart. And the market, in my opinion, is probably, is again, getting ready for a bit of a pullback. Now, I've been saying this for a week. We've been watching, the market roll over and then, still get bid back up, roll over, still get bid back up. Well, it's holding those trend lines and an 18-day moving average. That's a great indicator on the short term that if you want to, if you think if we think a swing lower is going to happen and you want to be a swing trader for that, that's my line in the sand right here at 144, let's call it, in the near term now for the live cattle. Breaking down our 4-hour chart there, you can see that upward sloping trend line on this chart here. We're back into the next in the series 50% long as well. So let's go through kind of the stair-stepping higher that we had for live cattle here in this upswing, and certainly just in this most recent swing. 2 steps forward, 1 step back, 2 steps forward, 1 step back, 2 steps forward, 1 step back, and now the old, any one of those levels you can draw up the fib. There's 150%. Here's the one that led into that one, right? So 2 steps forward, 1 step back, going the whole way up. The break of that pattern in that trend is technically below 144.30. So trend line comes in right around that area. 18-day moving average right at that area. The 61.8 line of the next in the series trend right in that area. 144 becomes a very key technical area to hold. We break back below it. We're sliding back into not only all of those technicals are breaking, but also back into the highs of July and the highs of June here. And I think we could see a much steeper correction in the live cattle. And of course, we would, could consider full 50% pullbacks down to 141. But again, a level I wouldn't be a buyer at without confirmation of a low at that point, because we're going to, have feeder selling off, live cattle selling off, and maybe even lean hogs selling off. So let's take a look at the lean hog contract here for just a minute. Big sell-off today. One of the biggest losers were the October lean hogs. Kind of a double top there and a double attempt to break out of 100 and a failure to do so. This is very reminiscent, this sell-off of, back here in April. And certainly I think that, we're on our way probably to test down towards this 200-day moving average at 90.95. Interestingly enough, there's an open gap down there too to fill. So we'll see what happens. Definitely oversold on the daily RSI. Markets can stay oversold longer than, longs can stay liquid. And I would probably be a seller on a move back up to the 97 to 98 area, which would also fill a small gap from today's price action. We'll look at that here in just a minute on that smaller time frame chart. But also the 18-day moving average up around 97.71. We are now down, and today's close put us below both the 55 and 100-day moving averages, which are clustered right around there at 94.50 to 94.40. But let's take a look at the smaller time frame chart now to see how this 4-hour trend or lack thereof could be, behaving. Yeah, so this to me looks A, B, and then maybe a big C wave down, which means we could be targeting this low down around 870 or 87.5. There's an upward sloping trend line against the lows that would, below 90 would, I think, call into question another test of this 3-month low kind of structure that we had here from May, June, and July's lows for the lean hogs. And the way we're moving to the downside, any rally here up above 95 to 97, I think you got to be a seller. and for the move down below 90 at this time. I just this was too much, too fast, too heavy, and unfortunately, I don't even think it'll let me in if I wanted to be a seller at this point. But certainly something to consider in the near term. Um, that October lean hogs seem a little toppy to me, and we'll need to pay pretty close attention to that here going forward. All right, let's shift gears here out of our agricultural futures and take a look at the dollar index, which has recovered incredibly well here from upward sloping trend lines and that 55-day moving average around 105.50 at this time, but it was a solid test of it there at like 105 evens. We talked last week about how we were testing into this trend line into the 55-day, and that was a big line in the sand that if we broke below that, call into question the 100-day at 103, is the 200-day down at 100, and then back below 100, we would be going and breaking back into a larger range for the dollar index that we had been in for the last 20 years, but really the last decade. But the dollar index caught a bid here. We are back above that 18-day moving average and holding trend lines against the lows. So the dollar and the Dixie may be heading to a new high, and that could continue to weigh on our export markets. But at the end of the day, if countries like China and other places need what we're selling in terms of energy products or foodstuffs, they're going to buy it no matter what the Dixie's doing. But the dollar index might be rallying here because of a little bit of a sell-off we're seeing in the bond market at this time. And I've got up here the continuation chart for the 30-year bonds. The full 50% retracement of this last swing higher comes in around 138. And so we're kind of, flagging or just kind of chopping our way down to that level. Last week of price action has told us absolutely nothing other than we've got a bit of a trend line against the highs that we seem to be respecting and certainly aren't willing to catch a bid. The stock market having rallied, up into, for example, the S&P being back, way out of recession territory and 600 points off their lows is certainly a reason that we could see interest rates maybe, continue a little higher and expect the Fed to continue to hike. But they certainly, in their last Fed minutes, came out and said that, not to necessarily expect those three quarter basis point hikes, but maybe more half basis point hikes regularly, or and tapered off here. So they are kind of keeping a cool lid on things, but they could always pull that trigger. Needless to say, the dollar rally coupled with the bond sell-off does kind of, to me, say risk on might be a part of the equation right now. Dollar strength with foreign money flowing into the U.S. market, bonds selling off somewhat, and certainly maybe setting up into a little bit more of a range. Because remember, we just came out of a big period of pricing in the rate hikes, and now we're kind of retracing that here. So a move down to 138 to 137 in the bonds, coupled with the dollar maybe going to new highs. I think getting below 131 is going to be a tough nut to crack, but needless to say, we'll see what happens. Could be setting up, a head and shoulders pattern here as well. So here's a left shoulder, the head, and if we come down and form that neckline around 137 and get a bounce back up to 142, we'll have a discussion about that head and shoulders. But at this point in time, it looks like a market that started a bit of a trend higher is now kind of retracing and consolidating. We'll see if support picks up anywhere, and certainly not until we get a break above this trend line against the highs would I start to think about a reversal at this time, and certainly not before we trade down to 138 in the very near term. But dollar strength right now weighing on the bonds is, I think, generally broader markets are trying to price in the Fed's next big decisions. Okay, and let's take a look at crude oil before time runs out on my Zoom. The crude market here very much, range bound at lows here for the last month or so. Irked out one new minor low, but then broke above the trend lines we had held for the last week or so of price action. Yesterday's bullish report of a 7 million barrel draw out of inventories. That's one of the biggest draws we've seen in a while. Couldn't sustain a rally, but then, we were unable to fall apart and head down to new lows. So today, I think the short covering has continued. So yesterday's price action into option expiration, I think sent a lot of puts into the money. And then today's price action is squeezing the heck out of all of those new shorts that got assigned options. The 188 strike, the 189 strike, and the 190 strike have gotten taken to the cleaners today. If you owned a 190 put, a 189 put, or 188 put, or anything in between, you were assigned a future after yesterday's close. Today, we're traded up to 90.25, and you're getting squeezed. Max pain is what's going on here. And so while I think that now that we've kind of reestablished and reheld that 86 area support, I think it's probably in the cards here for another test back up to the 94 to 95 area. And that could break the downward sloping trend line in this kind of channel we've been heading lower in for crude, and call into question a move to $10 to $100. Equal legs down, the 130 highs down to the 192 lows. Extend that off the 123 highs. 86 was that equal legs all the way down into upward sloping trend line here for crude. This was the supportive area we've been talking about expecting a swing from. We've been talking about trying to determine the short-term reversal when it happens. And I think crude's got it in it here that have moved back above certainly 92 and then 94, putting us back above those old lows. That I think starts it. And then I'm ready to be a buyer again in the crude on a move back to $10 or $100, maybe a back towards 110. Not necessarily calling for a move all the way back to 140 to 150, but if we were to see that type of rally and that type of move start to happen here, that to me would be the inflation trade coming back into full swing, and I think that could be rather bullish for multiple markets, including our row crops and other things here into the new year. But time will tell. We're at a seasonal time for our row crops where we could be seeing some more pressure mount, and I think we need to be aware and just kind of cautious of that, which I'm certainly trying to be with all my clients at this time, even though over the last week and we've put on some substantially more sideways or range bound type trades like selling strangles. Today and into yesterday and into today, we started removing the short sides, the short calls on those strangles, and even managing our risk by having sold some futures that got alleviated and taken out here into the end of the day, and now kind of flipping back to wanting to be a long, but doing so with a short put from that strangle trade, as well as managing maybe some long futures positions. But those aren't trade wrecks. Those are obviously very advanced means to trade through this range, but that is how I've been tackling this market recently. All right, well, that pretty much concludes today's Strategy of the Week webinar. I think we've, I guess one last market that I could want to throw just out there is cotton. I guess we haven't talked about cotton very much or regularly, but boy, did we just see a big swing higher here. Let's see if it wants to load. There we go. We were, limit up there for several days in a row. We finally cracked limit up, and the last 2 days have pulled back. But we're, basically having started trade above the 100-day moving average right here at 111. We seem to be wanting to stick there, and we're pulling all the other moving averages up. So certainly an open gap down here, 101.08. If we can't get down there to fill it for cotton, we could continue higher. This is an unprecedented move in terms of what we've seen from in our agricultural products, and certainly in the softs right now. It was our big breadwinner and the big mover over the last couple weeks. That has really turned into something. I don't really have a strategy other than, I don't hate getting long cotton here with stops below 111 for, or down to maybe 108 for a move back towards 120 highs, and maybe even towards contract highs if this upswing can continue. Watching this 18-day moving average, that's going to be a good trend indicator that as it drags it up, you can see that when the trends really start to begin, that 18-day moving average really holds as a pretty good supportive level and a good barometer for keeping the trend, the trend going higher. And could just be at the beginning of a cotton trend, but don't be surprised to see a little bit of a pullback in the near term. All right, everybody, thanks for joining me here today for the Strategy of the Week webinar. Remember, you can always get in touch with me at 312-277-0110. Find me on Twitter or shoot me a message on Facebook or an email at dhussey@zaner.com. Do sign up for the Strategy of the Week webinar held every Thursday here at 2 p.m. with the links in the comment section below. I will be closing this webinar back up and not doing it as a live stream and just going to the strategy of the days, which are good and all, but they're not as in depth as this webinar is. And oftentimes this webinar will come along, closing this webinar up means it'll also come along with some more in-depth trading ideas that we'll start to continue our discussions with. If you're interested in hearing more from what me and my team of analysts have to say over here at Zaner, you can also sign up for our Strategy of the Week, or excuse me, our daily newsletter. Sign up links are also available in the comment section and information section of this video. Have a great day, everybody, and we will be back with you as price action develops.